This is ETF IQ with Katie Greifeld and Scarlett Fu. We're going to start this truncated edition of the program with Passive Aggressive, where we explore the shifting dynamics of passive versus active investing. You look across asset classes, and metals prices are falling as the war with Iran pushes oil higher and increases the risk of damage to the global economy. Demand destruction is very much a term we keep hearing about. Joining us now is Todd Sohn, ETF strategist at Strategist. And not so long ago, commodities were on fire. Everyone was piling into gold, to silver, to copper. And then now we have the war in Iran, and it's a completely different story. Were most people exposed to metals through passive vehicles, or were they actively picking winners and losers here?
I think most of the flows were going to just passive gold, silver type ETFs. What's interesting now is you're seeing a sugar rush to energy, both energy equity, right? Energy equity ETF flows were pretty negative over the course of the last few years. Now we have a big rush to get involved. And I suspect you're going to see more money start to go to ETFs exposed to the underlying commodity space too, right? USO has seen some activity. Watch the ag space. Ag ETFs are a really niche corner of the ETF world. But whenever an event like this pops up, we're going to start talking about supply chains. People rush into them, right? The fast money. So I think this is a great time for investors to look at their portfolios and understand how much uncorrelated assets do I have. That's where commodities and real assets come into play.
Yeah, it's really interesting to see these moves, particularly in metals, because you think about gold, the record year that it had in 2025. To see it dropping right now, a little bit scary, but you mentioned USO, and that makes sense. I mean, oil is pretty much behaving how you might expect it to in a period like this. Yeah,
it's geopolitical volatility, right? The unknown, and oil's been lackluster for a few years, but now we have multiple shocks that markets are dealing with. First, it was gold and silver, for whatever reason it might be, and now it's totally transitioned to energy. It's really hard to pick winners in the commodity space. You really got to have your foot on the gas. So I think having an active commodity ETF makes a lot of sense. And that's a growing category. It's very small still, but that's a lot of opportunity for
Do you anticipate more launches in that space because of the increased focus?
That and managed futures. So managed futures only about $1 billion or so in AUM. But in the last year, you've had iShares, Invesco, and I think JPMorgan's going to be launching managed futures. Those are big managers. They're bullish on that category because you need the uncorrelated strategies. And go long and short commodities depending on their systems.
So I want to switch gears here because you and I both just got back from the Exchange ETF conference in Las Vegas. I am definitely feeling that right now. But a lot of my conversation centered around buffered ETFs. Of course, we know that they've been a very popular part of the market. I'm taking a look at the notes that you sent over to our producers. And when it comes to the buffer space, which, it tends to be pretty safe, I know that you have a little bit of a spicy take here.
Okay, so here goes. Buffers, $80 billion in assets, growing, massively growing. Goldman buys Innovator for $2 billion. They're clearly bullish on the category. I think Vanguard will launch a buffer ETF in the next 12 to 18 months. Why? There's demand for it. Salim Ramji's there, former iShares. They just brought on some folks who were at iShares and launched buffers at iShares. So I'm seeing breadcrumbs. I have no evidence here. I have no idea. Vanguard is very vanilla.
Yeah.
But there's clearly demand for here. If you think about advisors at Vanguard, they probably have clients saying, hey, I'm a little scared. I want these buffer funds on our platform.
Well, it's interesting because, you think about Vanguard, how they've acted and behaved under Salim Ramji's leadership. They've certainly gotten into areas where they haven't been before. Even just today, they filed for their first indexed high-yield bond ETF. But buffers are interesting because they're options-based. They're powered by derivatives, and that still feels decidedly on Vanguard.
It's different. But as you just said, they just filed for a high-yield bond ETF, which they do not have, now catching up with everyone else. And they're allowing crypto on their platform in very restrained allocations. But this is a different Vanguard. And if Eric were here, he knows Vanguard by the book, literally, right?
He wrote the book on it.
He wrote the book on Vanguard, so we trust him the most when it comes to this. But I just think there's these little breadcrumbs that are happening that says things are changing. And the buffers are an easy solution for a lot of advisors who are dealing with older generations and wealth.
Are buffers an easy solution for people concerned about inflation? Because that is definitely percolating. We talk about elevated oil prices, and people want to position against inflation rising.
So, stocks are usually an inflation fighter. But if I'm looking for further protection, I think given what's happening overseas with energy prices, we could be looking at a second wave of inflation. You're going to want to look at short duration tips, right? Long duration still has an interest rate risk problem. You're going to want to look at commodities in the managed future space. Distributing ladders is a newer ETF that's out there from Dave Abner. He's a great guy. And what they do is take tips, make a ladder that actually matures, so you're going to get principal and income at the end of the day. So you do want to look for ETFs that are going to have the hard assets in them, right? I think that's what it comes down to fight inflation if equities can't hold up to it.
All right. Well, right now, inflation is certainly something that's more of a boogeyman than actually showing up, although we do know that Jay Powell of the Fed had made clear that there's no indication that rates are coming down anytime soon until they get inflation easing for real. Todd Sohn of Strategas, thank you so much for joining us. Now, coming up on ETF IQ, we speak with Hamilton Reiner of JPMorgan Asset Management on the company's announcement of 2 new funds. We'll give you the breakdown. This is ETF IQ on Bloomberg. This is Bloomberg ETF IQ. I'm Scarlett Fu. Let's get you to the ETF life cycle, where we walk you through the 3 main stages of ETFs, from initial filings to final farewells. Step 1 is the filing. The SEC reviewing paperwork for VanEck's newest supply chain ETF. The firm has registered for a fund that focuses on the supply chain of data centers in its effort to give investors targeted exposure to AI physical infrastructure. Step 2 is the launch. 2 funds from JPMorgan Asset Management began trading today. The Equity Premium Yield ETF, trading under the ticker ROCY, and the NASDAQ Equity Premium Yield ETF, or ROCQ. Both are actively managed by the firm's U.S. Core Equity Group, which already oversees the popular funds JEPI and JEPQ. And for some, the final stage is farewell. T-Rex, a partnership between Tuttle and Rex, has liquidated 7 of their 2 times levered single stock funds. 6 were 2 times long funds on companies including ARM and DraftKings, while there was 1 double inverse fund on Ether. Katie.
Well, let's take on step 2, the happy news, and dive deeper into those new launches with Hamilton Reiner. He is CIO of the U.S. Core Equity Team at JPMorgan Asset Management. Hamilton, it's great to see you.
Good to be back, Katie. Thank you for having me.
So can I call it Rocky and ROCQ? Is that what how do you say this internally?
Absolutely. So if Eric were here, we'd say we named these strategies in honor of Philadelphia and Rocky.
There you go.
I know he's a Philadelphia guy. And then ROCQ, you know, this strategy hopefully will rock you, like Queen would say. We will rock you.
All right, love it. Rocky, how is it different from JEPI?
Sure. So when we first launched JEPI and JEPQ, the idea was to give folks distributable income and do it in a way that hits their 1099, shows up in their SEC yield. And then just 9 months ago, we launched a strategy called JOY-T, which actually reinvests those options premium in a very tax-efficient, tax-deferred manner so that you can accumulate. But what we have heard from clients is many of them like to defer taxes. And in a very tax-friendly way, we expect Rocky and ROCQ to seek the ability to defer the taxes on those distributions. So we will be the only asset manager that actually offers the ability to have a 1099 distributable, pay-as-you-go, a reinvest, or as a tax-deferred, tax-friendly product. And so Rocky and ROCQ, we think, actually fills out the suite for those clients, giving them the option, pun intended, as to how they want to consume the yield.
Well, it's interesting. When you think about JEPI, JEPQ, one is based, just on equities overall, and then a focus on JEPQ, specifically on the NASDAQ. A similar setup here when you think about, equity premium yield, Rocky, and then the NASDAQ equity premium yield, ROCQ. So talk us through that, taking that approach, breaking out specifically NASDAQ, but then also having the broader strategy.
Sure. Let's first start with NASDAQ. We would expect JEPQ and ROCQ's underlying long equity portfolio to be very similar. The difference would be how the distributions, or the yield, if you will, would be treated from an individual investor perspective. Qualified, not qualified, deferring, 1099, however they want to partner with us in these strategies. But the reason that JEPQ is one of the fastest growing active ETFs in the industry is because if we can combine growth in tech and yield and less risk, it's kind of a trifecta of things that fit into people's portfolios. Where else can you get income and growth in tech in the same strategy or portfolio? But ROCQ, it's about actually taking that distribution and seeking to defer the taxes in a tax-friendly manner for our investors that may actually care about deferring the taxes. Now, Rocky has some slight nuances and differences relative to JEPI. JEPI is a more defensive, high quality, very well diversified, very well diversified across sector and name strategy. We cap every name at 2%, so we're going to be underweight the megas. You get enough megas in your S&P and in your growth exposure. We like that. Number two, it's going to be underweight tech because we're going to cap every sector at 17.5. Do I like tech? I do. Actually, I love tech. But we're all getting enough tech in our S&P and our growth exposures. JPY adds some of that diversification. But one of the things that we saw from investors was they would combine JPY and JPQ to make it look like the S&P 500.
Oh, I see.
Right? If you put 40% in JPY and 60%, 40% in JPQ and 60% in JPY, it looks a lot like the S&P 500. It's going to have about 30% less risk and an 8 to 10% yield through a cycle. So why not offer to investors that S&P-like exposure, but with that ability to seek tax deferred? And then lastly, when I think about these strategies, it's really about giving optionality to how customers or want to actually, treat their yield and their distributions.
So for those who are buying JPY and JPQ together in order to kind of mimic the S&P 500, does that mean that they don't have any exposure to the underlying index through passive funds? I mean, are they using that as a substitute?
So one of the things, and I know Todd was just on before us, there are some very significant competitors in the space. The space has grown significantly, and you guys have been following it quite closely for years. We are one of the very few that manages our underlying equity portfolio in an active way. I mean, I am blessed to have a research team that has an annual budget of $200 million, having 5,000 company meetings globally per year. The modest premium that we actually charge our investors for over a passive strategy, or in many cases, our derivative income strategies are less than passive alternatives, is a key differentiator for us.
And I do think it's interesting, this focus on sort of the tax implications, because we've certainly seen a focus on after-tax returns. And from where I'm sitting, it feels like that's only become more urgent over the past couple of years. But I'm curious to hear your perspective on that.
So, Katie, I'm not allowed to give tax advice. We know that.
Of course.
And I won't. But what I will say is there's some people that actually say, you know what, the way my distributions are taxed, I would prefer to defer those taxes in a tax-friendly manner, or seek to have a PM that actually defers them, or a firm that seeks to defer them. And that's why we're bringing ROCKY and ROCQ to market. We're very intentional in what we do. We don't have a spray and pray approach, right? There's many firms that actually say, we're going to launch 50 indices, 50 strategies, and it's like, we hope something clicks. And we never want to be on that third group of the life cycle that Scarlett just highlighted, the closures, if you will. If we're going to launch something, we're going to be very intentional. So in working with our clients, we heard from them. They actually wanted us to come to market with an actively managed equity premium yield suite, both on the S&P and NASDAQ, that would give us the ability to seek to defer in a tax-friendly manner those distributions.
All right, Hamilton, fantastic to get you on today. Thank you so much.
Oh, thanks for having me.
Hamilton Reiner of JPMorgan Asset Management. Now, coming up on ETF IQ, we're going to drill down into crypto with Mitchnick of BlackRock as Bitcoin continues to struggle. This is coming up next on ETF IQ.
We're just about halfway through the trading day in New York. I'm Nora Melinda. Let's take a look at your midday movers. First up, oil and natural gas are rising after attacks in the Persian Gulf caused long-term damage to energy facilities. European natural gas futures have surged to more than double their pre-Iran conflict levels as the market braces for a prolonged shutdown at a critical LNG hub that provides about a fifth of the world's supply. Meanwhile, gold is falling for a seventh straight day, pressured by escalating tensions in the Middle East and fading expectations for near-term interest rate cuts. Silver is also sliding along with it. Losses are broadening across industrial metals as well, with aluminum plunging by the most since 2018 on the London Metal Exchange. Also, traders are dumping individual mining stocks like Alcoa, Newmont, and Barrick. Gold mining stocks drew strong inflows last year when the Bloomberg Dollar Index fell about 8%. But now with the Iran conflict dragging on, some investors are heading for the exits. And finally, Micron is falling after the firm warned that it will need to spend heavily on production to meet demand, with capital spending exceeding $25 billion this fiscal year. Still, Micron sales are expected to keep soaring, with fiscal third quarter revenue approximately $33.5 billion. Those are your midday movers. I'm Nora Melinda.
All right, welcome back to Bloomberg ETF IQ, where it's time for today's drill down, where we focused on one ETF. And today we're focusing on IBIT. This is the biggest Bitcoin ETF out there, coming from iShares. Total assets, we're talking about $56 billion here. So certainly quite a pile here. Let's talk a little bit, though, about performance. We know that crypto, of course, has been swept up in the sell-off that we're seeing in traditional assets as well. IBIT, we're taking a look over the past year or so, higher by about 51% in that time, but really focus on what's going on over here. Just in recent memory, you can see that after we hit those highs in October, November, it has been sort of a step down. You compare that to what we're seeing in the SOX and GLD, in the dollar index. It's pretty interesting. Gold, and that is that yellow line, has also been coming down as well. So Bitcoin actually a little bit resilient compared to what we're seeing, but that's really just if you focus on the past month or so. And given that it only holds one thing, we won't talk about holdings. We'll talk instead about flows. And I think that this is a really interesting and telling chart, because at least when you take a look over the past month or so, you can see that there's more green than red. More money is coming in than has been coming out. So maybe this suggests, Scarlett, that folks, at least when it comes to the ETF crowd, trying to time the bottom and maybe buy that dip.
Absolutely. All right, Katie, thank you so much. And joining us now to talk more about this ETF and the crypto suite that BlackRock offers is Robbie Mitchnick. He is head of digital assets at BlackRock. And as Katie pointed out, Bitcoin has actually held up better than gold of late. So far this month, Bitcoin did gain as much as 14%. It's kind of cut that gain down in the last 2 days, while gold has lost about 12% in March. Meantime, crude oil up more than 50%. The MSCI World Index down about 5.5%. Why the resilience in the short term when people seem very nervous about any kind of asset class, particularly those that are risky?
Yeah, well, we've actually seen this pattern play out a handful of times around these sort of large global geopolitically disruptive events, where you'll have an initial move sometimes in Bitcoin that is short-term and negative, and then within a couple of weeks, sometimes even sooner, it actually rallies. And that's consistent with how we view it from a fundamental perspective as this emerging global monetary alternative that's a scarce asset that exists outside of any one country's political, fiscal, monetary, et cetera, risk factors. So we saw it, interestingly, in the first Iran flare-up in January of 2020. We saw it when COVID started. We saw it with the U.S. regional banking crisis. We saw it in the Liberation Day last spring. And so this pattern is actually not uncommon, where Bitcoin then does start to rally coming out of these disruptive events.
And I'm curious to know what you see as the linkage between ETF flows and the price performance of the asset itself, because you take a random stroll on social media, there's a lot of conspiracy theories out there. But, you know, from where you're sitting at BlackRock, you know, managing the largest Bitcoin ETF out there, what does that relationship look like to you?
Well, it's actually been remarkable because if you look at year to date, even prior to the onset of the Iran conflict and Bitcoin getting a bounce and the IBIT flows really starting to come back strongly, even before that, the year-to-date flows were roughly flat in an environment where Bitcoin price action had been severely negative, right? And so if you think about that, the selling pressure that has existed in the market has been basically entirely in the direct crypto trading universe, and in particular on levered perpetual futures exchanges, where you get these cascading auto liquidation, deleveraging events that create these outsized price impacts. But the ETF investor base, which is consistent with what our thesis was, has proven to be much more of a long-term fundamental buy and hold type crowd.
For those who are bullish fundamentally on crypto, you have IBIT, of course. You also have ETHA, E-T-H-A. I guess that's how you pronounce it. It's a vanilla ETF tracking spot Ether, but you have now offered ETHB. ETHB?
ETHB, yeah.
There you go.
ETH-A and ETHB. Yeah.
All right, ETHB, which offers staking potential. What can you tell us about investors who seek exposure to Ether? Are they also in IBIT, or are they choosing Ether over Bitcoin?
Yeah, so I would say that there's plenty of overlap between the IBIT investor base and the Ether in general investor base. But there are some differences. There's certainly many investors who are only holding Bitcoin or IBIT, and that's in part because they're viewing it as this diversifying asset and this hedge for events just like what we're seeing with Iran. But then there's some, actually a smaller number, but only hold Ether because they're particularly excited about the bet that Ethereum represents on blockchain innovation and adoption. And so when these ETFs first launched, there was no staking allowed. And so that made the Ether ETFs a little bit of a suboptimal vehicle versus alternatives that existed to actually capture that staking yield. But recently, the SEC has now started allowing staking to happen in these products. So we were very excited at the end of last week to launch ETHB, which has all the benefits of giving you exposure to Ether, plus now this opportunity to actually capture that staking yield.
Well, as you said, ETHB only launched last week, and this is something I always wonder, when you see market volatility, you will see IPOs basically go on hold. Those companies in the pipeline say, we don't want to test the waters right now. Does that same attitude hold when it comes to ETFs? Or, when you're thinking about a product such as ETHB, do you sort of discount the market volatility and say, we're building it, they'll come eventually, even if the team is losing?
Well, we sort of fun historical fact. We filed for IBIT in 2023, just about at the bottom of the Bitcoin market. When we made a decision to proceed with that, Bitcoin was at 16,000. And FTX collapse and all the disasters of 2022 had just happened. So we try to take a long-term view, and in terms of the timing around ETHB, same approach. It's obviously paid off well because in the span of a couple weeks, the narrative has really turned, and Ether has bounced even more strongly than Bitcoin has coming out of the Iran conflict.
Well, some would argue that it wasn't so much as you timed the bottom, you caused the bottom, because after, a lot of the ETF issuers saw that BlackRock was going to file, then you saw this absolute onslaught. Scarlett, I'll never forget that period of my life.
Robbie, what do you think?
Well, I think that there's no question that these vehicles have greatly increased the capacity for mainstream investors to get access to Bitcoin and now Ether with staking. And so the market was excited when we did that with Bitcoin. It's proven to be obviously hugely successful. The market's excited in the last week that we now offer an Ether ETF with staking. So certainly there's a narrative benefit from that.
And you have a one-year waiver that cuts the fee, the 25 basis point fee, in half on the first $2.5 million assets under management for this new ETHB. How quickly do you anticipate reaching that threshold?
Well, it's been a pretty strong start. It's been another really promising start. Clearly there's a lot of interest, a combination of folks who maybe were holding off on their allocation to Ether, and now they have the right vehicle to do it. You have others who, particularly if they are not in a capital gain position, are selling out of a different Ether product and coming into ETHB. So, we're hearing very, very good things.
All right, Robbie, really appreciate you taking the time to talk to us in studio. That is Robbie Mitchnick of BlackRock. And you can read all about this drill down, plus the latest in the ETF industry, when you subscribe to my weekly ETF IQ newsletter. Geez Louise, the link there, Bloomberg.com slash ETF IQ newsletter. Now coming up, it's an IQ test where Joel Weber puts our ETF knowledge to the test. Here's a sneak peek at one of the questions. I'm going to take a quick read of this as well. This is ETF IQ on Bloomberg. This is Bloomberg ETF IQ. I'm Katie Greifeld along with Scarlett Fu. Eric Balchunas sadly not with us on today's show, which is actually good news for us right now because
we're trailing when it comes to the ETF IQ test.
Exactly. And that's what it's time for. Bloomberg's Joel Weber is going to see whether Scarlett and I really know our stuff when it comes to ETFs. Joel, of course, co-hosts the Trillions podcast with Eric, and he's also the head of games at Bloomberg. Joel, I love saying that every single week.
It sounds so good. Keep saying it every week. And by the way, you know your stuff. This is just a really hard quiz, always.
Yeah.
So we're going to have some fun.
Let's embarrass ourselves.
We don't have Eric here this week. He's playing from home. Let's see what questions we have for you. Question 1. The war in Iran has money pouring into defense-themed ETFs. Which of these funds has seen the biggest inflows so far this year? Is it Global X's SHLD, State Street's XAR, iShares ITA, or Wisdom Tree's WDF?
Wow.
Wow.
I feel like
It's a bunch
we
of
need to
tickers.
do
A bunch of
process
letters.
elimination here.
You want to do that?
Yeah.
Which one do you want to take out?
I'm going to say that European defense stocks already had their big run-up, so I'm going to take that
So
off.
you're going to take that one out.
That's
Okay.
smart. I had the same thought. You know the European
Are you
defense.
becoming a team right now? This is like a new strategy.
We're
Yeah.
allies.
We're chit-chatting. We can't help it. But as we discuss a lot on this show, it feels like investors really don't care about Europe. So I agree. I'm going to take that out. I'm going to gamble here and say that it's the Global X Fund, just because it seems like it's hard to bet against BlackRock, but that's a pretty clean title.
Are you feeling confident?
No.
Okay.
No.
Do you want to hedge?
I wish I could.
We can play with pointed rules here.
Yeah.
I'm going to go with the cheap option, which I'm guessing would be the iShares ETF, which is ITA.
Let's reveal our answer.
Oh my God! Wow!
Wow.
I feel good about that.
You know, that ticker is just one for the moment,
Shield.
right? Yeah.
Shield.
Okay, question
I see
number
SHLD,
two.
and I think Sears Holding.
The world's biggest ETFs, VU, IVV, and SPY, are about to change their holdings. You know about this, right? Which of these companies is leaving the S&P 500? A, Vertiv, B, Paycom, C, EchoStar, or D,
This
Campus?
is not an ETF question.
It is, because we've got 3 big tickers right up
True,
there,
but
right?
this-
And they're following an index, and that
Right.
index is going to have some changes.
I'm going to say C, EchoStar.
EchoStar,
Ditto.
okay.
Oh my God! Good. We're both wrong.
I thought becoming a team might help. Let's
know.
see if we can do it at the end here.
Okay.
Well,
that was
we
a
have
tricky one.
1 minute
because-
left. So.
Yeah, okay. Which company typically represents the largest position in Koru Directions Korea-themed ETF? So I think this is a good one for process of elimination. SK Hynix, Micron, Samsung, or BTS.
So no D and no B.
Okay?
Okay, I'm going to say C.
I'm going to say C because Samsung is bigger than SK.
Way to bring it home.
All right.
go.
Finally, we get
All
one.
right. 1 for 3, not bad. Well, Eric's rolling over wherever he is. But
There you go.
Would Eric have known that one, though?
I think so. Yeah.
Okay.
All right, well, Joel,
We'll find out.
rousing, challenging quiz as always. That is our head of games, Joel Weber. That sadly does it for this edition of Bloomberg ETF IQ. We'll be back on Monday, though. I'm Katie Greifeld along with Scarlett Fu.
With a new quiz.
A new quiz. This is Bloomberg.